Get into today's What's Up with the Markets Connect and Grow session. I'm just going to have a much shorter session, more focused session today, where there hasn't been many things going on in certain charts. I'm not going to waste time going through it. We're just going to go into the main ones, the more important ones. So before I do that, I have to tell you all that everything we cover here today is of a general investment advice nature, not personal advice, and that past performance is not a reliable indicator of future performance. Starting off with the Dow Jones. Right, Dow Jones, since we last did a session a couple of weeks ago, we've had this kind of upside down cup and handle, and there's the upside down handle. Now, that is not a pattern that happens all that often, although you do see it on the Dow more often than not. And if this is the reverse of a cup and handle, which a cup and handle is typically bullish, this could be bearish, but still too early to tell. We've obviously a lower high has formed over here, and we're right on this this trend line. So some signs to look out, pretty close to the trend line, and also on support over here, this blue rectangle. So on the Dow, things looking probably a little bit more negative than positive at the moment. And have to keep an eye on it. So the 30 large components of the Dow as an index are underperforming the S&P 500 at the moment. Onto the S&P 500, a lower peak seems to be forming over here, and there is a resistance zone, this blue resistance zone I have over here, down here, support. We're in this channel, and it is an open trade on SPA3 Investor. So there was the entry signal back there. So still low risk from a SPA3 Investor perspective, which is medium to longer term trend. So this trend is still up, just some early, as it is with the Dow, but some early signs over here of a little bit of, purely from a technical analysis perspective, some negativity, just some resistance being hit, and a lower peaks being made as well. On the Fibonacci, we still do have a pretty shallow retracement on this run-up that started back in October last year, so some 11-month run-up over here, and it's only been a 23.6% retracement on this run-up, so that's still pretty shallow. So some positive and negatives there, but we're certainly not in a raging bull market at the moment. Coming into September and October, which is traditionally a weaker period in the market, so we'll see how that negative sentiment, just purely from a seasonal perspective, plays out in the market. And if it sails, or not necessarily sails through, but if it holds up during September and October, we'll take that as a positive time, but there will definitely be some nervous Nellies around at this time of year. Right, let's have a look at some breadth of market indicators. Nothing really to tell you. When we look at breadth of market indicators, we're looking for divergence between the index and the breadth of market indicator. This is cumulative high, cumulative low, not really any divergence happening there, so nothing to take from that chart. And the same with this, which is a cumulative advanced decline line on the US markets, and no divergence there, so really nothing to talk about there. So, and we really are looking only for divergence in those two breadth of market indicators. Another breadth of market indicator, how many of the constituents are above their 150-day moving average, which is kind of a little bit more medium term. It's a breadth of market, and nothing really there. We've got about half of the stocks above their 150-day moving average, what you'd expect with the price action we've seen so far. Sentiment indicator, this is a ratio, which is this second graph over here. This is a ratio between the consumer discretionary and consumer staple. And if consumer discretionary is outperforming consumer staple, which it is at the moment, and we can tell that by this relative strength line, and what I've done to help smooth this a bit and get more definitive, almost mechanical-like indications on this, is I've put a SIROC, a smooth index rate of change indicator, on this relative strength line here, or the moving average of the relative strength line. So it's smoothing on smoothing, indicator of indicator. And it actually gives quite a good reflection of the direction from a trend perspective of what the ratio is doing between the two markets. So consumer discretionary rising, outperforming consumer staple. It's typically a risk-on environment. And that's what we have at the moment. While this indicator here is rising, we have risk on. It is a medium to longer term view. This is not short term. And so this is supporting a risk-on environment still, so no running for the hills yet, even though there's some minor, and I must stress minor indications of maybe this trend just weakening a bit from the two indices we looked at. You can see we've got a timing indicator here on the XLY, the consumer discretionary, and it did give an exit signal over there, that volatility base, that sideways, that weakness led to this ATR. This is adaptive ATR that we've modified. It's not a standard ATR, and it nearly broke out over here, but didn't. So no real weakness there, but certainly not any strength at the moment as well. So it really is a bit of a sideways moving market consolidation, if you like, and probably fighting the what's happening with the September-October seasonal annual thing that happens. Okay, this is the US dollar index against a basket of 6 currencies. This is probably the one that we should keep the closest eye on in the next 3 weeks, 4 weeks, but certainly is showing some importance there, because there's quite a strong correlation or negative correlation between the US dollar and relative to other currencies and the S&P 500. So we've had a breakout over here of the S&P 500, of the US dollar index, and you can see that it does kind of a little bit work negatively as well as the negative correlation. So I've put an indicator on here, the CIROC, on the US dollar, and that is rising at the moment. Now, it's not a relative strength, and that's something that I'll bring in future ones, is doing a relative strength between the two and do some smoothing on that. But this is if this US dollar continues to rise, it's going to challenge stocks. So we will keep an eye on that one. So that's another little bit of negative news in the mix. The VIX had fallen to pretty low levels over here. If you go back, it did jump on today's session in the US, but it is right down at low levels as well. So there's no real indication there. Certainly the jump in today's session is very early days, but VIX at pretty close to all-time lows. Right, moving on to the NASDAQ. NASDAQ did give an exit signal here. There was a nice trend over there, a trade, which we could have done on the triple Q or even other leveraged NASDAQ ETFs. But here we are seeing the NASDAQ remaining within this channel, this upward channel, about in the middle of the channel between the upper and lower channel lines, and a little bit of outperformance over here in the S&P 500. So NASDAQ is slightly outperforming at the moment, and we're going to have a look at another sentiment indicator in a moment to give us an idea, just drill down a little bit as a sentiment, if you like, on risk on, risk off, to give us a further indication of the strength of the US market at the moment. Right, so NASDAQ rising, and sorry, I should also say that it did give an exit signal over there, so it hasn't really given, and it hasn't given an entry signal yet, and I should not use the word really, it hasn't, because this is a mechanical timing system that we're talking about here, and waiting for that to happen. That, I would say, just on that 1 or 2 bars, this, if you're using a 3-day swing chart, a peak hasn't formed yet, whereas it would have on the other 2 indices, and looking to take out these peaks over here, these recent peaks, and to remain, if there is a bit of a retracement, to remain above these troughs is really what we're looking at from a price action perspective. Breadth of indicator on the NASDAQ, no insight there. There's no divergence between the two. That's a cumulative new high, new low on the NASDAQ. Right, the 100-day moving average, it's we've got 2/3 of the NASDAQ stocks above their 100-day moving average. And so that is, there's no real information we can gain from that, except that there is a bit more strength than weakness from the number of stocks that are above their 100-day moving average. Right, this is a new sentiment indicator that I've brought into the mix here. It is looking at the Philadelphia Semiconductor Index. And there are some other semiconductor indices that you can look at. It's an industry sector rather than a JIC sector. So we've gone down a level from the upper level sectors or the spiders that you might look at. And as part of the of the information technology spider sector. And I've done some timing on this just to manually back test it. Effectively, it's a relative strength I've put over here of the SOX, the Philadelphia Semiconductor Index, to the S&P 500. So we're comparing it to the S&P 500, and if we've got typically growth type stocks that are outperforming the S&P 500, the broader index, that tells us that we've got more of a risk on in feel sentiment, if you like, around the markets than not. So what we're looking at here, and I've put the SIROC as well, the smooth index rate of change. I've got a slightly I've got a shorter time frame on the parameters here than the other SIROCs that I've put on the other relative strengths. Is that when the SIROC is rising and is above its moving average, we've got a risk-on environment. And when it gives a sell signal, if you like this, like it did over here, as we're starting to get into a risk-off environment. So that's why I've put the red vertical line there. And at the bottom, I've got the S&P 500. So using this, if you like, as a sentiment indicator on the broader market. And I've gone back to, I think this indicator goes, or this index goes back to what is that, 1998. You can see all the red and the green indicators I put over there. And, it's not perfect, but it is a bit of information to bring into the mix. And it was good enough for me to say this is a good enough sentiment indicator to use. So at the moment, we have a risk-on environment. We're waiting for, as long as this SIROC indicator stays above, and particularly if it's in the above the 90, which is that blue is in the zone greater than between 90 and 100. And the good thing about this indicator is that it's indexed between 0 and 100. It doesn't move about the 0 line like some of the other momentum indicators. And this is more of a trend indicator than it is a momentum indicator. So it'll stick with the trend. So it's not trying to predict like momentum indicators do. There was the risk off happened over there, and it was pretty good. And there was in the risk on happened using this indicator to get back into the market. So at the moment, and this index has stocks like NVIDIA, Micron, which is MU, which is a semiconductor manufacturer, AMD. So it has a bunch of these risk-on type stocks that are fairly volatile and run when we have a positive market. So just looking at the raw price action, there's a very, very neat, well-formed channel here with lots of touch points on the upper channel line and lots of touch points on the bottom channel line as well. And it's sitting right around just below the median of the channel line. So this indicator, the sentiment indicator, is saying it's risk on at the moment. So taking all this into consideration, we're kind of in no man's land at the moment, waiting for the next move. And as I said, we really do want to, in the American markets, see if this market holds up to what's typically a negative seasonal time in September and October. Right, one other thing to look at on the US markets before we look at the Australian market is the this is the 10-year Treasury note, and this has broken out above the and I'll just zoom in a bit so we can see it's a bit more obvious. It broke out above this upper trend line here and is rising, is making higher highs and higher lows. Now, people talk about the relationship between bonds and stocks, and it's not a clear-cut one. There are far more clear-cut relationships to look at in the market, like the US dollar equities is a more clear-cut negative correlation, and typically the people talk about a negative correlation between equities and stocks. Now, if you go back and look over the long term, there are plenty of times where yields and equities move in the same direction, up and down as well. And there are some times when there's a negative correlation. So it's not one that I put as much credence on as some of the other relationships that we can look at. But when there is a negative correlation, it's a pretty strong one. And we don't know whether this is going to be a negative correlation or a positive correlation, this breakout in yields that's happening here at the moment. But we certainly have had times where they both move up, and you can download this in your own instance of Beyond Charts, and you can have a look at those times where there's the correlation isn't negative, it's actually positive. So, but if we are looking at it to err on the side of risk, as there being a negative correlation, then this the CIROC rising over here means that the Treasury note, the yield on the Treasury note is rising and therefore should be negative for stocks, but shouldn't be used on its own. So that's one of the little one of the variables to throw into the pie. And just to finish up on equities, I'm just going to go and have a look at a couple of commodities. I'm not going to go through all the commodities this time because there's a whole bunch that nothing's really happened. So rather than to show you nothing's happened, I'll look at the ones where something is happening. But before we do that, the all ordinaries are still in this, as people have pulled me up for using the word dog's breakfast, and it still is a dog's breakfast and has been, you know, since April of 2021. That is it's much lower than what it was back then. And this range trading market continues, and, you know, little periods of outperforming the S&P 500 and underperforming the S&P 500, and now just matching it over the short term. For this market to get a go on, we really do need to see a breakout here above the 7,800 level. It's currently sitting at 7,515, and at the bottom end, you know, supports around about 7,100. So we've got between 7,1 and 7,8. There's like a 10% range trading band over there that it's moved in for most of the last 2.5 years. And it does need to break out one way or the other to get a trend going one way or the other. And it's highly unlikely it's going to happen in the next 2 months, which is going to continue making, as it has for the last 2.5 years, you know, getting go ahead in portfolio equity curves in the Australian market. Right, last one to look at is the Australian dollar, weakness in the Australian dollar. And, you know, one of the indications I'll be looking at here for the Australian market to get some go ahead is international money coming into the resource stocks. And when international money comes into our resource stocks, then people are moving into Australian dollars, and that's when the Australian dollar will rise against the US dollar. And there's no sign of that happening at the moment. So we would typically see that happening, and it's not happening at the moment. Right, just some quickly look at some commodities. I did mention Bitcoin. It had a big break down below its channel line in the last time we met. It's hanging in there at the moment. Indecision after the breakdown, and but not falling yet, but certainly not one you want to be in. It's there's no sign of this a turnaround yet. So if you're trading this long, then you don't want to be buying it. It's way too early. I've got a CIROC indicator over here that I put on Ethereum. That's also a pretty similar price action to Bitcoin. And I know quite a few of our customers use the CIROC indicator to go long on Ethereum or even on Bitcoin as well, but it hasn't turned. There's no entry signal down the bottom over here. 3 commodities I want to look at. Uranium. Uranium is sticking to this channel line and behaving quite well. There's a bit of you know, movement around in uranium stocks in the Australian market down at the penny dreadful end at the moment. And that's where the action is at the moment, where the swarm of bees are going looking for the honeypot in, you know, short-term leveraged or short-term volatile stocks to look at. So that is in an uptrend and might augur well for the penny dreadful end of the market. The iron ore is also looks like it's found a bottom. They had a fairly big bar up over there. I have kept this, I have drawn a light gray over there. So we're looking for a breakout above this light gray line to get potentially another volatile run up like that, which could then spill over into the iron ore stocks. And lastly, just to look at thermal coal, that breakout over here has still continued. We haven't seen a fall yet, and that is rising, and thermal coal could lead into you know, coal stocks, and that also are rising. Thank you for your attendance and your time. And as always, I wish you consistent and objective investing.